on for a period of time, it's hard not to get caught up in the either euphoria or pessimism of the market prices at where they are at that particular moment in time. Going back to real estate, I think real estate is really mostly a forced savings vehicle. There's no magic to real estate. It's a kind of a forced savings vehicle, and we've been fortunate enough to live in a part of the world in more recently in a period of time when real estate has been an asset class that has created good performance. You can argue about why that is, what are the demographics that have caused that, and real estate is financeable too. So in many situations, your capital requirement is only maybe 25% of the value of the property. So obviously, if the property goes up in value, and you've only contributed 25% in capital, then your return, your levered return, looks even more appealing. And financial institutions are willing to finance real estate, homes, in a pretty aggressive manner, and for for periods of time. So that's what I think about real estate. I think it's a forced savings vehicle. The real rates of return over time are not much different, not as good as investing in the stock market, but more recently better than investing in the stock market. I think mutual funds are probably not the best mechanism by which to invest your money because of the issues of the professional managers face in their careers and their closet indexing and too much capital and over diversification and all those things. And so I think if you're kind of a basic investor, no nothing investor, just wanting to participate, as I said earlier, you could achieve that by just investing in an ETF, an exchange traded fund, or some kind of index fund at a very low cost, and you will produce over time greater wealth than you would have with volatility. You'll get greater wealth than you would have had if you just kept the money in the bank. And then there's the opportunity to do more than that by either kind of educating yourself about opportunities to buy companies and finding a process that works for you. For us, it's value investing. It could be something else, but that's the one we think makes the most sense because it's the most business-like. There's a framework for making buying and selling decisions. And then you've got to consider whether you actually have the temperament for it, because a big part of this is not intellectual capacity. I think Warren Buffett has some joke about if you have 150-point IQ, you should give 30 points back because you don't need them. What you do need, though, is the right temperament, because when you make investments in visible assets that have a marketplace, an exchange, where at any point in time somebody's willing to buy or sell them, you'll see variability in the price. And so your ability to withstand those ups and downs in pricing, probably by holding to a philosophy like value investing, where you're actually looking at the underlying business and what it truly is worth, that's the temperament that you need in order to succeed in this. If you don't have those things, you still have the opportunity to engage a professional manager to do that for you, somebody who does have a process and temperament that's worked. But you still have to kind of do your homework with those people too. You've got to make sure, as I said earlier, that they're not managing too much money to make them ineffective. Whether maybe their track record was established on a small amount of money, now they have a larger amount of money, and they'll be able ever to replicate what they did in the past into the future. What constraints they have upon them, institutional constraints. They can't invest in this, they won't invest in that, because, like it or not, the most successful investments are those that are obviously under-owned. So what does that mean? It means companies that are out of favor. It means companies that are smaller in market capitalization. That's where you're going to find the opportunity to create value above and beyond passive index